I think the economy is basically running on fumes right now. So, and that's why you're starting to see this weakness creep in. I mentioned the herd on the street column in today's Wall Street Journal, and that it was revealing because the narrative in the press has been everything's great. The economy, everyone was fooled. The economy is a lot stronger than we think, and we're going to have a soft landing, and you name it. But here, as we speak today, I can tell you the Wall Street Journal has the big article by Aaron Back, my former student, and the herd on the street column is June 3rd. A lot of economic slowdown data are popping up.
I'd like to welcome Professor Steve Hanke back to Wealthion. He's been an advisor to President Reagan on economics. He's taught at several prestigious universities and is presently a professor of applied economics at Johns Hopkins University. Professor Hanke stops by often and always has a wealth of knowledge about what is really going on. Professor Hanke, welcome back.
Great to be with you, Andrew.
So I'm going to start with a loaded question for you. What is going on with our economy? I know that there's a long-winded answer, but what is really going on with our economy?
I think the economy is slowing down. One of my former students, actually, who's a deputy editor of the Herd on the Street section at the Wall Street Journal, has a piece in today's Wall Street Journal. And the nub of it is that all the indicators are kind of flashing yellow. The economy's starting to slow down. Now, this doesn't surprise me because money is what makes the economy go around. That's the fuel for the economy. And the money supply since March of 2022 is actually contracted. And we've only had 4 contractions ever in the history of the Federal Reserve since 1913. All those other contractions have led to recessions and economic slowdown. So I'm not surprised that the economy is slowing down.
So you mentioned one of your students. Why the heck are you still teaching?
Well, I like to do it. As I say, it's a labor of love.
Yeah, I guess when you do something you love, it's really not a job. So you must really love imparting the knowledge.
You know the old gag. I've never had a job in my life.
That's awesome. So, since the money supply, as you put it, and the quantitative theory of money, and the money supply is contracting, is what the Fed doing working with the higher interest rates?
Well, in a sense, it's working. But remember, the Fed we got to put them in the dock here because they've conducted I think one of the biggest monetary blunders in the history of the United States since COVID in early 2020. First, they put the accelerator to the floor, and there was an unprecedented rate of growth in the money supply. It shot up to a high of 27% year over year, and that occurred in February of 2021. So to show you how high that is, number one, it's never reached that magnitude before. Point number one. Point number two is that Hanke's golden growth rate for the money supply growth that would be consistent with hitting the Fed's 2% targets around 5 or 6%. So 27%, you see, is like 5 times higher than the golden growth rate. So they shot the thing up, and what did we get? We got by mid 2022 with a lag, we had inflation peak out at 9.1%. Then the Fed puts on the brakes, and we have this contraction in the money supply that I mentioned, only had four of them historically in U.S. history before. And so you said, well, is the Fed doing the right thing? Well, it's just been doing the wrong thing all the time. And it's overdone this breaking. That's why I think a recession is probably baked in the cake. And I think, but John Greenwood and I, who work on this together and apply the quantity theory of money, think that inflation will be down around 2.5–3% by the end of this year. And then going into 25, it'll probably drop down to something below 2%. And the key thing there, Andrew, most people don't realize if you get money dominates, money is the fuel for the economy. But the reaction to changes in the money supply, they come with long and variable lags after the change occurs. So most people are just completely out of it. They're looking at today's newspaper and what is happening with the economic indicators and in the financial markets, but they don't realize that's all caused by something that happened to the money supply maybe a year and a half ago, 2 years ago, maybe even 3 years ago.
So we're looking at a lag, and there's a report out now by the Cleveland Fed that says 2% may not be achievable till 2027. Do you see that in your research? Do you see that happening? Because
it'll happen by 2025.
So we'll be down to a 2%, and interest rates will interest rates come down first, or
no interest rates follow inflation. So bond yields follow inflation. So like the 10-year bond, I haven't looked at it today, but it's more or less like 4.5% or just a tad maybe above that. That 10-year yield will come down as inflation comes down. So it's a place to park your money. That's a pretty good trade, actually. The yield is pretty good. The yield will come down, so in a year you'll have a nice little capital gain on the long position you have in a 10-year bond.
So looking at the stimulus, and we talked about the pandemic and how much money the government pumped into the economy, not only to people themselves, but to corporations. They gave out this money to corporations that had a good attorney that could go or accountant that could go and ask the government for money, whether they needed it or not. How long does it take for that amount of money, the trillions and trillions of dollars that they pumped in, to actually bleed out and slow things down? Because people were still spending this money even at the end of last year.
Well, the bleed out kind of you had this excessive buildup of money, and that has been all dissipated really in this last quarter. It's gone now.
So now we're seeing actually with the last PCE number that came out, that their spending is coming down, but at a very, very slow rate. Should we expect this to pick up because that money is gone?
No. Well, the slowdown will pick up. To put it, the slowdown will pick up. So let's put it this way. I think the economy is basically running on fumes right now. So, and that's why you're starting to see this weakness creep in. I mentioned the herd on the street column in today's Wall Street Journal, and that it was revealing, because the narrative in the press has been everything's great. The economy, everyone was fooled. The economy is a lot stronger than we think, and we're going to have a soft landing, and you name it. But here, as we speak today, I can tell you the Wall Street Journal has the big article by Aaron Back, my former student, and the herd on the street column is June 3rd. A lot of economic slowdown data are popping up.
So you talked about the Hanke's golden growth rate of 6%, and at one point it was 27%. Can you elaborate on what that 6% is? And I guess to achieve the 2% uh, rate that the Fed is looking for, you need to have a 6% growth rate.
Right. So uh, you got to go back to the quantity theory of money and do this quickly. Uh, the equation of exchange, uh, and the equation of exchange, the equation of exchange is the following: mv, money, v is velocity, equals py. P is the price level and y is the real rate of growth in the economy. So if you just quickly, if you actually transform that into logarithms and differentiate it, you get something that people can work with, and that is m plus v equals p plus y. And if you rearrange that and solve for m, you have m equals p plus y minus v. Now, if you plug the numbers in, what's p? P is the target for inflation. That's 2%. Y is the potential growth rate in the U.S. economy. It's about roughly 2%. It's a little over 2%. But this, for us, back of the envelope, we're kind of using what they call Fermi's method. And Fermi's method is by Enrico Fermi, the famous physicist. This is what they call Fermi back of the envelope kind of calculation. So we're trying to solve for m. That's on the left hand side of the equal sign. Then on the right hand side we've got p, and that's 2%. Plus y, that's another 2%. Y is the potential growth rate for the economy, and the velocity is minus 2. That's roughly what that is. So we have 2 plus 2 plus 2 is equal 6.
All right. So if we were to get or keep that 6% growth rate, then inflation will get down to 2%.
By the way, let me clarify. On the V, the V is actually a minus 2%. But if you switch it and get it on the right-hand side of the equation, you got a minus and a minus.
Right.
It turns into a plus. So that's why we got 2 plus 2 plus 2.
Right.
Just so people don't get confused.
Yeah. The negative of a negative is positive.
Andrew, if they're taking notes on what we're saying.
I was jotting stuff down, but a negative of a negative is definitely a positive. So
yeah,
we can look at it that way.
Yeah. Anyway, go ahead.
So I have a question about banks. Now, we have a reserve rate right now of 0%, and we're trying to contract the economy. Why doesn't the Fed go to the bank and say, okay, you know what? You need to now have a 2 or 4% reserve rate because we want to take money out of it. We want you lending less and keeping more in your bank. Basically, we want you putting less money out there. Aside from interest rates.
That if they did do that, by the way, it would be a disaster because the money supply is already contracting. And most of the money supply is created by commercial banks.
Right.
Roughly about, more or less always between 80 and 90% of all abroad money produced in the United States and most other countries, by the way, is produced by commercial banks. People don't realize this. They think the Fed produces all the money. No, the banks produce almost all the money. The banks are the elephant in the room. And you're right, Andrew. If they put a reserve requirement on the banks, they would loan less than they are right now. And right now, they're barely making any loans. They're not contributing very much to the growth in the money supply. Very, very small. And they have been actually negative. Loans have only become positive year over year in the last month or so. So one reason for this, by the way, is that they are doing one thing. increased reserve requirements or put a positive reserve requirement on, but they keep threatening to increase the capital, what they call the capital asset ratios, the amount of capital that banks need, and that slows things down. If we go back to the great financial crisis, the 2008 post Lehman thing, most people don't understand what was going on. Remember, we had three tranches of quantitative easing where the Federal Reserve pumped up the money supply, their contribution pumped up, and the balance sheet of the Fed expanded, and everybody said, "Oh, we're going to have a lot of inflation. This is going to be a disaster." Well, that never happened, and the reason why is that the banks actually were making a negative contribution to the money supply, and the reason they were is that we had Dodd-Frank financial regulation putting a noose around the neck of the banks, and we also had what's called the Basel capital asset ratios. Basel III came in, increasing the capital asset ratios, and that caused them to constrain. So if the Fed hadn't been quantitative easing, we would have had really a huge recession because the banks weren't producing any money. They were actually contracting money. So most people don't understand that. That's one of the great misunderstandings. And what was going on? As a result, the money supply was growing at a very slow rate, actually a little below the golden growth rate. It was, for a long period, and after the great financial crisis, it was growing at less than 5% per year. And that's why the recovery took so long, and that's why we never had any inflation. Inflation stayed below the 2% inflation target. So all of that's just total confusion because people don't understand the quantity theory of money, and they don't understand how to measure money. They don't understand how to slice and dice money and so forth. By the way, if you look at the money supply measured by M2 and look at the components of it, you have only 11% is actually produced by the Fed now. That's notes and coins, currency, about 11%. 76% are liquid deposits in commercial banks, and then we've got equally split the residual between money market funds and short-term private savings accounts. Those are the components of it. So the huge amount, 3/4 of it, are liquid deposits at banks, and only around 10%, 10 or 11% are notes and coins. What we have in our wallets.
Right, and that those liquid deposits is what the commercial banks use to lend out to make loans.
Well, they are the liabilities of the commercial banks, meaning it's your checking account. it's your money. That's why it's money. I mean, if you go in right now and write a check someplace, that's a transaction, a legitimate transaction, assuming you've got money in the bank, and what it's like cash. Write somebody a check, and they give you an automobile or whatever you're writing a check for, groceries or you name it.
Yeah, I just had to do that this weekend for my son. So I did write a check, and the bank said, "Yep, the check's good," and my son got his car. So I understand exactly how that works.
Yeah. Good for him.
Now,
he talked Dad into a good deal.
Yes, he certainly did, but he deserves it. He's a good son, and he's off to medical school, so he's in really good shape there.
Yeah.
Now,
good. Yeah, good for him.
So, Professor Hanke, we had 4 recessions since the 20s, 4 contractions since the 20s that we talked about. The biggest one coming in the late 20s, early 30s, which the economy contracted, the money supply contracted by 39%. that was a pretty lengthy recession, nearly 3.5 years. How long has, or what's the contraction this time? And do you
It's
have a
about
formula?
4%. It's about 4%.
So do you have a
It isn't
formula as
near
to how
it
long the
isn't near
recession
as
will be?
great as 1929, to 1933. That was a massive. That was the Great Depression.
Right.
We've never had anything like that. The other ones, there was one in the late 40s, then there was one, I think 36, 37, and then there was one in the 20s. But all of those were actually not even as great as this 4% number. There's only been one really mega contraction in the money supply. That was the Great Depression, 29 to 33, and the other contractions that I mentioned, there were three others in addition to that. They were all somewhat a little bit less than the current contraction.
So do we have a perfect storm coming up? I mean, unemployment is relatively low, but it's creeping up. And it seems like unemployment is going to continue to creep up because there's all this talk of layoffs and stuff like that. The economy's still doing okay. Is this a perfect storm where we are definitely heading into a recession?
Yes, it's really baked in the cake. Now, you're talking about the labor market. Everybody says, "Oh, the labor market's great. The labor market's great. Unemployment's low." But you did mention something that's important, Andrew, and that is it's come off the super low and risen. It's unemployment's going up. It's still very low, but it's increased by 5%, by a half a percent, half a percentage points. It's and when it does that, we always have had a recession. So that's the threshold. If we have a half a percent increase in the unemployment rate, we end up it's always followed by a recession. So it isn't the level that's so important. That gives you one view of the thing. It's always in economics, everything, as they say, is always determined at the margin. It's the delta. It's what's changing, and unemployment is becoming more severe.
So we have somewhat higher unemployment and we have a recession on its way. How do we explain the stock market just continue the S&P, although down off its highs, and the Nasdaq? You attribute that to Nvidia and AI a little bit, is still reaching new highs. How do we? I know that people look and say, "Oh, the economy's great, the stock market's doing great," but that's not exactly the case. Even though the
Well,
stock
I
market
think
is
we're
rolling
in
along.
I think we're in it. I'm not saying it's. I'm not calling it as an internet bubble like we had, but we have. If you go back to 1881 and you look at Professor Robert Schiller at Yale's inflation-adjusted PE ratios, the way he calculates it, we've only had 5% of the time when the inflation-adjusted PE ratios have been this high or above since 1881. So we're in pretty elevated territory. I'm not saying we're in a bubble. I'm just saying the stock market's very pricey right now. So I think there's quite a bit of exuberance, shall we say, in the market. And if you look at somebody like Warren Buffett, for example, why is Buffett building such a huge pile of cash and not investing in the market? Now Buffett's rule, by the way, which I think it makes sense, when Buffett was looking at Apple to go big time, Berkshire has a huge position in Apple. And at the time he went into that, they had a small position. For Buffett, that was about $1 billion. And his people came in and they said, Warren, this, we might be thinking about putting a little bit more money in here to Apple. What do you think? And he said, I want to know this. he said, I want to buy something that's well priced, with a PE ratio, 12-month forward earnings, 15 or less. So that's one thing, 15 or less. And then he said, I also want to know whether there's a 90% probability that earnings will go up in the next 5 years, over the next 5 years. And the third thing in Buffett's rule is the earnings. He wanted to know if the earnings, if there was a 50% chance that the earnings would go up by 7% per year for the next 5 years. So low PE, below 15, earnings going up 90% chance for the next 5 years, and a 50% chance that those earnings would be going up at least 7% per year. Now, if you apply that rule and look at stocks, there aren't many out there, I don't think, that cut it. So that's a little bit consistent with this thing with Bob Schiller's inflation adjusted PE observation, that it's so I would characterize the market as, a lot of exuberance. By the way, you mentioned, or implied, the Magnificent Seven. The breadth in the market is not that great. Right. You've got a few techies that are running the market and running the averages up. But if you really look at the breadth of the thing, there, a lot of dogs and cats in there that aren't doing much of anything.
Yeah. So, Professor Hanke, I want to touch on pricing a little bit. Pricing has been up about 18%. And if we head into a recession, there was a lot of people or a lot of companies that were hurting during the pandemic. I don't expect pricing to come down that much, but if people aren't spending money, is it a cyclical thing? If people aren't spending money, you want to bring the consumer back and you need to lower prices. Do we get this back in line? There's so many things that seem to be so expensive these days. How do we bring this all back in line?
Yeah. The overall cost of living, as you say, has gone up around 18, a little over 18%. But that's really not coming down. You would have to have a huge depression to bring that overall thing down. Now, there are various things, that we've seen some price cutting going on, and that is not all that unusual. But price cutting at one store or one fast food operation is not the whole index, because fast food as a category, that's just one component of over 300 items in the consumer price index. So yes, and there are some things, by the way, that actually have gone down in price. Some high-tech items, for example, have gone down over the last 3 or 4 years. Not many, but some. I mean, so the pricing thing depends on the industry, the competitiveness of the industry, supply and demand.
So, but we're at a point where, at one point wage growth was increasing at a nice rate. Wage growth has sort of flattened out, but prices haven't come down all that much. So it's going to be tougher and tougher for consumers to spend money, especially with unemployment ticking up. There's fewer people working. That money supply will continue to contract.
Well, yeah, and of course, the real wage adjusted for inflation has gone down since the pandemic. That's one reason people are, they say, oh, everybody says the economy is great, the stock market's great, but why is everybody so gloomy about everything? Well, for the average Joe, and I'm not talking about Joe in the White House, their real income has gone down. I just saw some numbers this morning, by the way, that the real income adjusted for inflation went up in Trump's presidency more than it did in George W. Bush's, Obama's, and Biden's all put together. So that shows you why, by the way, that some people have pretty fond memories of the economy during the Trump presidency. I mean, if you put it into context, there was a lot of real income went up quite quite in a quite healthy manner.
And spending didn't come down at all, which leads me to my next question. What, Professor Hanke, are we going to do about this debt? 35 trillion and growing. Every 100 days we add a trillion, and obviously with bond prices, we're servicing this debt as it continues to go up. And the last time I think that it came down was under President Clinton, and then it continues to go up. I mean, under the Trump presidency, there was spending like it was going out of style. Under the Biden presidency, it's spending is crazy. And now that we're in an election year, well, the spending's not going to stop. That's for sure. So we're digging ourselves a bigger and bigger hole.
Yes. Now, one thing with all this debt and interest rates going up, so when they roll over the federal debt, the interest costs go up. To put that thing into context, now the interest on the debt is now larger than the defense budget, and people have to think the interest on the debt. Taxpayers, you can argue whether taxpayers really get much for their taxes anyway, but they get nothing for interest. If they're paying interest, they're getting nothing. So it's a huge burden on the taxpayers, the interest. The debt is unsustainable. I mean, even the bipartisan Congressional Budget Office, all our forecasts show that this is not sustainable. We can't keep doing this. And the question is, well, how do you stop it? If we can't keep doing it, it will stop, by the way. If something can't continue, it will stop. So the question is, well, what will make it stop? Well, one possibility is to rein in government spending. That's possible. The other thing is to increase taxes. That's possible, and there are two ways to do that. One is to direct taxes. You pay your taxes every April or every quarter when you're estimating your taxes, and if they're increased, you're going to be paying more. The other way to tax is with an inflation tax. So we have restrain government spending, tax you directly or tax you indirectly with an inflation tax. So or some mix of those. So
Can you elaborate on an inflation tax?
Well, we just had one. I mean, we're in the middle of one right now. I mean, inflation is clearly taxing us. I mean,
so you're just raising the interest rate, and that's the inflation tax.
Well, no. The inflation tax is the cost of living going up.
Gotcha.
That's the price of everything going up, including, by the way, including interest rates. They changed in 1983 the way that the consumer price index was calculated. In the old days, they used to include interest cost, like mortgage cost and lending cost in that cost of index. If that was included now, and we actually were calculating the way we used to calculate the inflation rate, the consumer price index would be a lot higher than it is, but because of interest would be included. These mortgage rates would be included in the cost of living or consumer price index calculation. It's not now. So we have an inflation number. That's the way they're calculating it. If we would go back to the old 1983 method, it would be a lot higher than it is now, and people would say, "Well, Hanke, why is that?" And I would say that's because in the old days, part of the aggregate for the consumer price index number was interest. That was a part of the cost of living is the interest you have to pay.
So with all this debt and with all the
Well,
bonds that
well, just a second. Let me ask how to solve this. So we have three ways to do this that I just gave you, the three components.
uh-huh.
Now, institutionally, you could have arm twisting, log rolling, and the usual political process, and they split it up between controlling government spending and the inflation tax and direct taxes. That could be just political bargaining. That's one way. The other way is to put a fiscal rule in, a statutory change, like the Graham-Rudman statutory change that occurred in the past, and that would be a rule that would control a thing or squeeze it down. The problem is that these statutory changes, they never really last very long and really don't work very well. So that leads to another institutional change that you could do that I'm for, and that's to have a constitutional convention under Article 5 of the Constitution, and in which you would hopefully put in something like a Swiss debt brake and change the U.S. Constitution. So instead of changing a statute, which they don't work very well, these statutory rules, you would actually change the Constitution and put in something like a Swiss debt brake. Now people say, well, what's that? The Swiss had a referendum, and the Swiss debt brake that's in the Constitution says that the government expenditures can't go up any faster than the rate of growth in the economy. So that controls government spending. And then as far as the deficit is concerned, the Swiss debt brake forces them to balance the budget over a fairly short period of time, 2 to 3 years, and the 2 to 3 that has to be. It can go up a little bit and up and down, but over a 2 or 3 year period, it has to balance.
That seems to make a lot of sense. I mean, right now we're spending 126% of GDP. That's clearly not sustainable. And if we could balance them, we don't even have a budget. We sort of, Congress votes every few months about adding more money to pay for things, and it doesn't seem like we have a budget going forward.
Well, we're operating, in fact, outside what we would term a normal budgeting process. This has been going on for quite a while. I mean, and it's very hard for people to follow what's going on. I mean, because as you say, where's the budget?
Right, exactly. Yeah, it's not. Look. If you or I were to spend 126% of what we earn, we would have a very serious problem very quickly. But the government doesn't see it that way. It would be really nice if they could say, okay, we make X, we have X to spend, or we can borrow a little bit more, but 26% more is a lot for the country to handle.
Well, it's a real problem, because if to keep the analogy with a personal budget, it would be like running up a huge amount of debt. That what happens is that after you die, your son, who's going to be a medical doctor, hopefully, he would pay off all your debts. Somebody's got to pay. This
Right.
idea the idea that the government can run up deficits and debt and no one pays, it's a joke. I mean, you learn this in economics textbooks. This kind of rubbish is in there, and people actually believe it. But somebody always pays, and it's somebody in the future. So
Right.
so what we're doing, there's a moral argument here, and that is how are elected officials today given the right to actually impose taxes on people who aren't even born yet? Because
That's a really good
those
question.
people who aren't born are going to be paying for part of this, Andrew.
Absolutely. Absolutely.
And
So have we
and how will they pay? They'll either pay in direct taxes or they will pay in an inflation tax, one of the two.
so are we devaluing the dollar to the point where the dollar, the dollar is what kind of rules the world right now? Are we devaluing the dollar to where, bricks could possibly be to take over, or some other currency, the yen
Well,
perhaps?
we're okay. We see the de-dollarization in the press all the time, almost daily. The dollar's using value, losing its place in the world. It's going to be overtaken by some BRICS currency or cryptocurrencies or something like that. Well, who's pushing this idea? Number one, it is an idea that doesn't comport with what we see in current exchange rates, because if you look at the trade weighted value of the dollar, it's almost at its all time high. The dollar is very strong right now. You go to Europe, by the way, and you're gonna have a great summer because the dollar will go quite a ways. so so
You just gave me an idea.
yeah, well, exactly. So at any rate, um, it's being pushed a lot. There are two avenues that this comes. The crypto evangelicals push it because they're pushing crypto, and they're going to say that the next thing that's better than sliced bread is a crypto, which is not correct. The second group are basically the enemies of the United States. So you have a big propaganda machine, the BRICS crowd bad mouthing the dollar all the time. While if you look at any BRICS country, everybody residing in BRICS countries, they want to keep dollars under the mattress.
Last thing I'll ask you about, Professor Hanke, is about gold. And it seems like there's countries around the world, China included, that is hoarding gold at this particular point in time. Any idea why?
Well, some of it is related. I'm not saying there's nothing to the de-dollarization thing, because the U.S. is placing sanctions on people and countries, and that they've weaponized the U.S. dollar to the extent that sanctions are tangled up with the U.S. dollar, and that means what you do want to de-dollarize. It gives you an incentive to de-dollarize. Now how do you do that? Well, gold is a good way to do it, because gold is not issued by a sovereign. It's not a liability of anyone. It's not like fiat money is. It's a liability of whoever the issuer is, or if a bank is makes a loan, that is also it's on the balance sheet of the bank. That's not the case with gold. So gold is attractive in that respect. If you Gold is not issued by the United States.
So, in basically, to sum it up, Professor Hanke, we got to hold on to our hats. The money supply is contracting, and every time the money supply is contracting, we end up in a recession. And you believe we're headed there relatively soon?
I think we'll see one by late this year or early next year.
I appreciate you coming on, and we always love to hear your insights. So thank you, Professor Hanke.
Thank you, Andrew. Great to be with you.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could, like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell to find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.